This chart shows the number of non-farm jobs held by California residents. California's jobs market finally surpassed the pre-recession 2019 peak in October 2022, with 18 million Californians employed as of July 2023. However, as shown in this related chart depicting the annual change in employment in California, the jobs recovery pace continues its year-long deceleration, with jobs growing at an average rate of just 2.8% over the past 12 months. Even as California just reached a full jobs recovery from the 2020 recession in late 2022, another more significant economic recession is tightening its grip on the jobs and housing markets. Watch for job losses to begin heading into 2024, with the effects quickly chipping away at the already anemic housing market. Prepare now for unemployed homeowners mired by negative equity to pursue distressed sales in 2024 through 2025. This chart displays stock pricing on the S&P 500 index as well as the price-to-earnings PE ratio. The stock market's PE ratio is the reciprocal of the capitalization rate for real estate investors. Thus, the PE ratio of 20.5 in the second quarter of 2023 is equivalent to a cap rate of 4.9%. This is unrealistically low when looking ahead to probable economic conditions in 2024 and beyond. Savvy income property investors demand higher cap rates to stay ahead of rising interest rates. After 2022's plunge in stock prices, the stock market officially gained bull market status in the second quarter of 2023, having climbed over 20% since the bottom. But the stock market has long been detached from reality, hitting new heights following 2020's job losses and the unsustainable impact of stimulus payments. Watch for more volatility as stock market investors react to the oncoming economic recession heading into 2024. This chart shows the number of single-family residential and multifamily construction starts in California across 6-month phases. Single-family construction starts were 14% below a year earlier in the 6-month phase ending July 2023. Meanwhile, multifamily construction starts were down a slight 1% from the 6-month phase a year earlier. What accounts for this difference? Legislative efforts to add to the state's housing stock deliberately seek more multifamily construction. But these housing starts have remained essentially flat since 2021. By 2022, builders were beginning to cash in on the legislative incentives and rising homebuyer demand when leaping mortgage rates and spiraling sales volume and prices crushed builder sentiment and new construction starts. Thus, residential starts will not reach full stride until after the 2023-2024 recession, when prices bottom around 2026 and the recovery picks up steam around 2027. Once residential construction takes off, inventory will gradually rise to a sustainable level. This will help meet the demands of homebuyers and renters, restoring the housing market to a level where supply and demand find balance.